Biases in decision-making among investors exist, and behavioral economics has attempted to crystallize them. A leader in the field, Richard Thaler, joins me to share his insight on its evolution. Now, you stumbled into behavioral economics while lecturing at the University of Rochester. Tell me, what did you find was missing in existing economic theories?
The main thing that was missing were people, or at least people as we recognize them. The way economists characterize human behavior is through fictional creatures with the Latin term homo economicus. I just call them econs for short. And these creatures are really, really smart as the smartest economist. No emotions, no self-control problems, no need to diet because they weigh just the right amount, no hangovers because they never drink too much, and they're complete jerks. They would never leave a tip at a restaurant that they didn't intend to go back to. Have trouble with long division if they've been out of school for a while. Doing a net present value calculation would be completely beyond them. They can't quite stick on their diet, they don't exercise enough, they don't save for retirement. So where are these people in economics? I thought they were missing. And I've basically devoted my life to introducing economists to people.
And that led to your seminal work. What sort of behavioral biases have you identified amongst investors?
The list of mistakes investors make is too long for this TV segment. You know, one of the important findings in behavioral economics is something called loss aversion. The way we experience life is gains are nice, but losses are awful. And so if you win 100 pounds, that makes you feel good. If you lose 100 pounds, it makes you feel about twice as worse. That means people are very sensitive to losses. One example of that is if you look at people's portfolios, they're quick to sell their winners and they hold on to their losers too long. And at least in some countries like the US, that's a silly thing to do for tax reasons. Another thing we observe is overconfidence. Everybody thinks they're an above average investor. What do we see from that? We see too much churning. People turning over their portfolios, which costs them money. The evidence is that the stocks that people buy do worse than the stocks that they just sold to buy them. So just doing less would be good. Maybe if I pick a third one, I would say is that we see a lot of herd behavior. People get carried away, they extrapolate the recent past into the future, and they sometimes seem to act like what goes up must go up faster.
Let's apply your observations to China.
China, again, I'm not an expert on the Chinese economy, but from what I've read about it, they look very much to be in the midst of a stock market bubble. All the signs lead to that. It looks to me, it reminds me a lot of the late 1990s and the technology bubble. What are some of the signs? We see a big inflow of new investors, unsophisticated investors, in the Chinese case, uneducated investors. The new middle class, often without a high school education, are investing. We see people using leverage, buying stocks on margin. We see extrapolation bias, thinking that because the market's going up so fast, it's going to keep going up. Now the government seems to be intervening and trying to prevent stock prices from falling. On this one, I'm a perfectly standard economist and say the efforts along those lines can't possibly work. Eventually, right now, they're have a bunch of stocks that aren't trading and they're urging all kinds of people to buy shares. Eventually the market's going to clear, and if those prices are too high, which is what it looks to be, then they're going to fall.
Now, how is the bubble going to pop, and just how disruptive will it be?
How bad it will be depends a bit on how much leverage there is. The crash of the technology bubble in the US did not cause a catastrophe the way the crash of the housing bubble did. And the difference was leverage. Yes, when technology stocks fell by 2/3, people lost a lot of money. But when you have leverage, 10 to 1, then if people are losing $10 for every $1 the price falls, then you have catastrophe. And that's what we had in the financial crisis and the betting on all the mortgage-backed securities. I don't know enough about the Chinese market. I know there's some leverage, and how bad things will be if prices go down depends on how much there is.